What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is July 30th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, we've got a wide range of topics to cover for the update. Starting off, I'm going to show you guys just how much more beneficial looking at the long-term chart is for finding both short-term and long-term price targets in crypto markets. And along with that as well, we've got a few key major news topics. We're going to be talking about how Tether is being used to launder hundreds of millions of dollars. Interestingly enough, digital fiat being used to launder money, who knew? And outside of that as well, the major data breach of Capital One, as well as some growing concerns as we go into the Federal Reserve meeting either today or tomorrow. So we've got lots of things to discuss. Let's go ahead and dive right into it right after our quick sponsor. Our sponsor for this episode is Shrimpy. Shrimpy is a free application that crypto investors use to manage their portfolio. Starting off on the dashboard, you can see a graph of your portfolio value and each asset in your portfolio. Since you can link over 15 different exchanges to a single Shrimpy account, you can keep a complete overview on your entire portfolio. It's easy to trade on Shrimpy. Just select the assets you want in your portfolio and Shrimpy will buy and sell them for you. Setting up a rebalance period will make the process automatic. Besides creating your own portfolio, you can also copy portfolios from other users in the application. If you like the leader enough, you can follow them to get real-time updates from their portfolio. Check them out by clicking the link in the description. Alrighty, everyone, so let's go ahead and do a quick run through the market. We've got lots of things to discuss today. As we can see, most cryptocurrencies are in a no-trend scenario between 1 to 2% to the upside or downside. If we take a look here at market capitalization, again, we're pushing sideways at the moment, but I do think there is still a chance, even though I've already started averaging it and just added some more to my altcoin positions yesterday. I do believe that there is a chance we can continue to set a third real serious final low here on market cap, and it could come all the way down here between 200 to 220 billion, which, bear in mind, guys, was a very key level for crypto markets for a variety of months. You can see within this window of time, crypto markets held up here for some time, and when we broke that level, it was very significant. So it would be really good to come down and make that support before we continue the rally, especially after having such an exuberant rally like we've had. But again, I don't know if Bitcoin's going to have the ability to go down that low. We might get buyers coming in already at those ranges. Now, let's go ahead and talk about Bitcoin here, guys. I want to talk about the long-term chart. Now, we had talked the other day about some two key indicators that I was using in order to find the corrective periods for Bitcoin. And one of them that I think many people will probably refrain from using because they usually prefer to look at the shorter time frames is the 21-week moving average. Now, as I've talked to you guys, I not only believe you should look at the long-term perspective, take a look at the logarithmic chart. You can adjust it by hitting the log chart here. It's going to make my indicators go all wacky if I don't have it on logarithmic. But anyways, to give you guys a little bit of perspective as to how I view Bitcoin, I use what's known as the Bitcoin Liquid Index. If you type in BLX in this case, you'll be able to find it. Just make sure to select the first one. And it'll give you a very nice weighted index of a variety of major both exchanges as well as the volume paired with those exchanges. So it's basically weighting Bitcoin's price on a daily time frame and taking in all that information. So you can have a nice good indicator of historical price action. We can go all the way back here to July of 2010. So we've got a lot of price action to work with. So as we take a look at this chart, why do I emphasize taking a look at the long-term chart, guys? Well, it simplifies so many things. As we can take a look here, I'll go ahead, actually, I'm going to expand the chart just so we can really focus in on it. Now, if we take a look here, I've got a few key moving averages here that we have at play. We have the 21 SMA, the 50 SMA, and the 200 SMA. Now, the indicator I'm going to be focusing in on is the 21 SMA, and we're looking at this in a weekly time frame, okay? So why is the 21 SMA an important indicator? Well, while so many people right now are trying to dish out when we're going to get a rebound in markets, when we're going to find the final low in markets, I'll be honest, guys, I can't tell you exactly what actual number we're going to print as the final figure. But I do have some decent evidence looking at previous history to showcase when we could find some support as we exit out of the accumulation phase. All we really have to do, if we're actually looking for some relevant data, is take a look at the previous cycles. Well, I'm going to go ahead and turn off my cycle boxes here. We'll take a look at that in a second. What indicator proves some utility here out of those three? To me, it looks like the 21 week, the blue line on the chart here. As you can see the measurement value up here as I start to scan along the chart, what price level it's at a given time period. And we can see price fell on support here at the 21 week. Anything below the 21 week was a buy here, continued to ride along there. And every time we came back to that 21-week moving average. It was a buy every single time, not only in the exit out of the accumulation, but really in the next cycle as well, until the point where there really was no retest back to the 21-week until it was a bear market. So you can see here that it does hold some serious significance. And even though a lot of people say, Nick, how do you think it's going to go down to the mid $7,000 range? It doesn't really have to go there. It can go to the low $8,000 range. As this indicator starts to move up and price continues to correct, there can be a middle ground between where these, both the price and the indicator meet. And it's at a level that's probably more practical. Not to mention as well, guys, I would not fret out the idea that this could happen, because we've had a really strong rally. In the previous, exit out of the accumulation phase, we had multiple corrections in the process between 30 to 40%. And at the same kind of recouping of price action towards the previous high in this cycle, we've been able to do this at a much faster pace. It's been one of the fastest recoveries for Bitcoin that we've ever seen. So very, very interesting to take into account that, I think we could easily come down to this marker here. And it's one of the most relevant indicators we can look at that actually holds serious consistency as to when it's a good time to buy into Bitcoin, right? So I'm going to keep averaging down this range, guys. I'm not going to wait exactly for contact with it, because history does change sometimes, but a lot of factors of history repeat themselves. And it tends to be that just so many investors and traders, they're looking at the daily or the short-term time frames, and they're not looking at the weekly or the monthly, right? These are the significant time periods we need to look for. That's exactly what happened here with the 200 week. Look at that. 2 tests on the 200 week before the market exited. Look what happened here. 2 tests on the 200 week. It's a simple indicator. It's not some crazy, Wall Street insider indicator. No, it's a very commonly known indicator, but people don't use it in the most effective way, which is on longer time frames. Now, there's another factor here with the long-term time frames. When we take a look at the logarithmic chart, is understanding again where we're seeing resistance and where we're seeing support. And the logarithmic chart, where it's so good for Bitcoin, because the logarithmic chart, Bitcoin is a new asset in this case, and you're going to have these exponential cycles, especially with the block halvenings, with the finite supply, with again these kind of waves of new eras of adoption, from institutional adoption to retail adoption. You reach these kind of wider audiences, and you have the network effect come into play. So again, as we can see here, even though we have decaying returns in each cycle, for example, we literally did 1,000x in this cycle. In this cycle, we did a 579x in the sense of the valuation from top to bottom. We almost did a 100x in this case, in this cycle. I believe that we are going, and sometimes if you can't see it, guys, just click off the auto button so we can expand up here. You guys are welcome to copy this chart. We're basically looking for, in my opinion, as we line up with history here, the resistance line, we're going to be looking for a 30x from the lows down here. So we're already a well ways on our cycle in the moment, and not to mention, if you want to put some perspective with, a revisit to 20,000, it would basically be a 5x at that point. All right, we're going to get a 5x from 20,000, in my personal opinion, from what the chart can tell me, and it's going to be sometime in the later part of 2020 or in the early part of 2021. That's what I'm currently estimating at the moment. Depends on how fast the cycle moves. It might take a little bit longer, and who knows, we might actually hit a higher price target than that, maybe even a slightly lower one. But this is what we can guesstimate, and the longer term chart provides a really clear image here, right? It doesn't make it too difficult. And again, push comes to shove, we're off by 10,000, or we're underestimating by 10,000. It doesn't matter. The long-term chart can give us a very reassuring picture that, hey, we probably shouldn't be focusing in on what's happening on a daily time frame. We should be focusing in on what's going to happen over the next 2 years, right? Again, as I mentioned, guys, this is my kind of philosophy on how I take investing. You are limited in the time that you have on this planet. You're lucky if you live to 100. Maybe we'll have some modern medicine that'll push us to 110, 120. That'd be really cool. Makes us feel like we're 40. Anyways, the fact of the matter is that you are going to get a few opportunities like this in your life. And I'm not trying to say that cryptocurrencies are right for you. You're going to have to determine that for yourself, guys. But there are very few asset classes that can move in these kind of cyclical patterns that multiply time and time again over their original valuation. And I think this is one of those. I really truly believe it. I've traded in a lot of emerging markets. I've traded in emerging tech sectors, semiconductors, pharmaceutical companies, all kinds of different things. There's companies in different industries that move in cycles. And I have to say, it's not only exciting to be investing in cryptocurrencies for its investment potential possibly, but along with that, the fact that this is a really revolutionary technology that, I mean, it just has some of the most exciting financial innovation that I've seen out of any industry. There's nothing going on that excites me like this. So to doubt that Bitcoin can go to 100,000, I think is ignorant in a case. If you truly understand what Bitcoin is and what it can do, and the fact that Bitcoin will be used as a programmable protocol for developing all kinds of different ways to interact throughout finance, I think, again, a lot of people still don't know the big picture of Bitcoin. So it's going to take time. You know, we're still in the beginning phases, and don't feel as if you're too late to the game. Now, I want to spend some time to talk about this. Now that I've rambled on enough about the chart, I want to spend some time to talk about how, yet again, you know, it's funny. I could have swore that as I listen to the media, that Bitcoin is used by criminals as the ultimate choice. It is private money, right? That, you know, that can't be traced whatsoever, and not to mention as well, you know, it has no direct connections to any platforms that might have had KYC on the users who bought them. No. Oh wait, actually, yeah, I was wrong on that. It actually is dollars. That's kind of funny that the government, you know, would probably be genuine and honest with us. Maybe they're trying to protect the value of their currency and the reputation of their government's currency and keep people from using something that's alternative and out of their control. Might be off on that, but who knows? Anyways, well, did you guys know that if you digitize and cryptographically generate new dollars that are pegged at a supposed 1-to-1 ratio between other physical dollars in some offshore bank across the world, that those too can be used for laundering? I know, it's crazy, right? The option that people usually choose to launder money across the world, and now we're digitizing it and putting it into a form of a stable coin, and people still use it to launder money. What? I just don't get it. I don't get why they would use it. Anyways, I'm being overly pessimistic, guys. So there's this new story that kind of blew up out of nowhere over the last 24 hours that most of the major media outlets in crypto are talking about. And they're discussing about how USD Tether has become a prominent choice between Russia and China for people who conduct business between the two countries. And we're seeing about $30 million a day in Tether being exchanged at these OTC desks in Moscow. So it's a really fascinating story. I mean, I don't want to spend the whole time diving into it, guys, but it's definitely worth the read. It's not too long of an article and really kind of reads like a story, guys. It's fascinating. So they basically talk about the things that, you know, people have already pretty much known at heart, and that's the fact that people who want to launder money, especially dealing in business with dollars, they're going to want to use something like Tether. And the reason why is because they like the fact that it's pegged to the US dollar. They like as well that it's a gateway for Chinese business individuals who are doing these OTC transactions, that they're able to actually have dollars to some degree that are out of the bounds of capital controls. And in the case of Moscow, you know, it's bringing, you know, in the case of the OTC desk, you're bringing in volume, you're bringing in liquidity in this space, and you're actually able to charge exchange fees in this case between the two parties in Russia and China. And there's a lot of commerce business that's done in Moscow that has ties to Chinese business. So that's what's going on here. It's at a desk where they're actually making exchanges similar to how they would in traditional OTC desks. And it's very, very fascinating. I think you guys should read through it. It's a good article. And again, I think it speaks to the fact that in the sense of irony, it's like, you know, this is a stable coin. It's tied to the US dollar and it's being used for criminal activities. There are 800 US dollars used every single time a dollar of Bitcoin is used for criminal activity. If the government ever tries to convince you that Bitcoin is used by criminals, show them that statistic. It was found by Chainalysis, and I can't remember exactly the government agency, but I think it was something along the lines of, it wasn't Department of Homeland Security. It was one of the major, I don't think it was the FBI, but it was one of the major industries, the industries of government. That's a funny way of saying it. One of the major offices in government and stuff that had discovered that deals with criminal activity. All right, so we have one of our favorite individuals who's yet again continued skeptic of crypto, Peter Schiff, who we've had on the channel. And as much as Peter drives me crazy, I love the guy. You know, he was one of the first few people who got me interested as a contrarian into finance. Still would love to have dinner with him one day. The fact of the matter is, and not to mention, Schiff has been killing it with like the beard as of recent. I like his beard. It's looking good. Anyways, want to talk a little bit about Schiff's continued skepticism on cryptocurrencies. One of the things that he brought up recently in a talk with Billy Wu, who's a Bitcoin proponent, is that we've seen a decline in overall volume for Bitcoin. So this is his thing. He said that the Bitcoin volume is much lower than 2017, and because of that we're not in the next cycle. Now I want to build a few points here. Let's just go ahead and just kind of talk about the tweet here. I want to make sure everyone gets a clear picture of what Peter put out. If Bitcoin really is gaining in popularity, why was the volume on the most recent rally so much lower than during the 2017 rally? If interest and adoption have peaked, so too has price. That's why this rally peaked so far below the 2017 high and why the 2019 low will not hold. Okay, so let's make something very clear. Let me actually get the volume indicator on here so we can have some data to look at. And not to mention, we're taking a look at the liquid index here, so we're not taking in the volume from other platforms, for example, that might be doing a lot of excessive market making or wash trading. And I'm actually going to bring the volume down here to a new panel below so we can get a really clear picture here. All right, so I think Peter's argument here, first off, if there's less Bitcoin actually circulating, we're seeing more people holding it, that's actually not so much a bad thing for Bitcoin. It shows that people are not letting go of it, that the supply is even more limited, and that's going to lead towards some lower volumes over time. But that's not even exactly the case. To say that we're not seeing as much volume, I think, is a little bit misleading. If we take a look back here, for example, in the previous cycle, and we might be able to see more Bitcoin circulating. I have no doubt about that. You might be able to see that there are some bigger spikes back here, that we haven't seen a huge growth in this case for the amount of circulated Bitcoin. But the thing that Peter's not taking into account is that he's looking at a time frame where Bitcoin's price was between $200 to $400. That's not a fair measurement. In fact, if we actually take a look at in the sense of dollar terms, in the sense of the liquid exchanges, which this indicator measures, we're dealing with very high counts of volume in this case. Now again, if you take a look at the actual bull run here, and even weighed in price, you can see that we were processing more volume towards the end of the cycle. And that's the key point here. Peter doesn't really kind of clarify the fact that we're in the warm-up of the cycle. We are just beginning here, folks. We've got a lot more room to go in this cycle. And if you guys do believe this is going to 80 to 100K, and it's going to tip out at the next level here on the logarithmic line of resistance. So again, kind of misleading statement on the sense of Peter's part. But I have no doubt there isn't the crazy retail adoption that we had at the end of 2017. We're not going to get that until we pass 20K and people are starting to FOMO in. That's just with any investment. It's the same exact thing with gold and silver and stocks. Most retail participants get in on the later phases. It's one of the most unfortunate things in the world, but it's the fact of the matter. If you're here right now, if you're bullish on gold and silver, these kind of hedging markets as well as cryptocurrencies, and I think Peter would agree in the sense of gold and silver, you're in the right camp right now because we're starting to step into a market where, again, people are overtly exuberant and the underlying fundamentals are starting to come to rot. So again, very important stuff. But Willy Woo in this case, I don't know why that was Billy Woo. Willy Woo, who's a pretty prominent person in the sense of crypto Twitter, but not to mention as well in the data science related to cryptocurrencies. He's one of the helpers in creating NVT. The main thing that he put out here is that the previous rally that we saw was mainly a cascade of short squeezes. Now, I think this is a very good point. It's the reason why we saw such a rapid rise up, because people were all just shorting Bitcoin from the highs. And there was this huge unknown reversal that came in with hundreds of millions of dollars of liquidity buying up Bitcoin on spot that pushed the price up much higher. And that's what has kind of sparked this rally. We haven't seen, real liquidity coming just yet. It's been small level retail money at the moment. So again, I think that there is so much more fuel to the fire that needs to come in. But I think as time will tell, we're going to talk about a topic here in just a few minutes that I think will lead us to that. Now, wanted to mention this to you guys. Capital One, one of the many awesome banks in the United States, has let a data breach of over 100 million customers in the US and Canada have a compromisation on their personal information. This has happened way too many times, guys, and the story behind it is pretty crazy. They basically had one individual who was able to access all this information, and for months got away with it until they had been too much of a loudmouth talking about the fact that they had access to all this information. Someone luckily reported it, and all the damage had already been done by then. The woman has been arrested who was in charge of this. She looks the part. She looks like she'd be someone who'd steal a few identities. But the fact of the matter is that they are trying to deal with it. And guys, this is, I think, the need for sovereign identity. This is the reason why we need to have ownership over our own information, and that we shouldn't be so careless with giving our data away. This is just becoming more and more of a problem over time. And until we find ways, it's one thing to have this data, but I'm more worried about the fact that people can run away with this data and utilize it for malicious activity and utilize it for all kinds of different activities. We need to have a way to verify that when someone says, I am so-and-so, that you can confirm that the only person who can say that is yourself. And I love what Estonia is doing and all these countries who are working in digital identity, but we need to pick up the pace. We need to create something that is a standard that people can use and trust, whether that's new technology or just, again, coming together and building some kind of new standard with pre-existing technology. We need to move quick on it. This stuff cannot happen anymore. It's just downright disgusting that companies are getting away with this. And we know, Equifax, for example, you guys can actually go claim that you were affected by it and possibly get up to a $125 voucher or a free year of credit checking. You should definitely go do that if you guys were affected. But the fact of the matter is that they're never going to actually pay the penalty. I'll go ahead here, but I'll bring it back to the NASDAQ chart in a bit. But Equifax, look at their stock. Completely recovered, looking to press to new highs. Corporate America and the corporate world in general seems to get away with just about anything. And they don't face the consequences when things really go wrong. I think it's sickening. I think it's wrong. It's not free market economies like I know it. So, anyways, all right. So the Eurozone, this is something that we have to focus on here. Sorry, I got a little bit on a tangent about that. The Eurozone is an area of weakness right now in the sense of the broader economy. And again, no negative speaking towards those of you guys who are in any countries under the Eurozone or Europe in general. Love Europe. I've actually been hoping to make a trip out back there, even though I went back in April and we got to visit the Netherlands and Switzerland and a lot of my favorite places out there. But the major thing to take into mind here is that as we're stepping into the FOMC meeting, either today or tomorrow. I think it's more likely to be tomorrow. We haven't heard any, big announcements since. So you can see it's going to be either on the 30th or the 31st. The major thing we need to watch for is how both the European currencies and the bond yields are going to react to the Fed's decision. Now, the whole idea here is that there's a continuous competition a bit across central banks. If the Federal Reserve decides to cut rates 4 or 5 times, it's probably going to be good for currencies in the Eurozone in this case, from the euro as well as other competing currencies. So you have to watch things like this. Sorry, I spoke about it as if there's multiple currencies in the Eurozone. There's the euro. But what I meant to focus on in this case, as I'm doing everything in one take, is the yields on the bonds. Okay, so you're going to see a dramatic shift depending on what the Fed decides to do in this instance, policy decisions. Now, again, from my understanding, if the Federal Reserve decides to cut rates more than the markets expect, in this case, that is going to be a hamper on U.S. Treasuries, thereby giving relief and some possible demand for German Treasuries, Italian Treasuries, whatever it may be, right? So, we're already starting to see rates negative in the Eurozone. I don't think they need anything else to put pressure against their bonds, right? So we'll have to see, time will tell, but this is going to be a really big event. And it's not only going to be a really big event for the kind of broader fixed income markets for treasuries and bonds. It's going to be a very interesting case scenario for stocks. We've just pressed to all-time highs here just a few days ago for the NASDAQ, for the Dow Jones, the S&P 500. Most of the major indices are pressing higher. And we have talked about NASDAQ 10,000. If the Fed cuts rates more than expected, I'm talking about, planning 3 rate cuts over the next year and more to come in 2020 and painting a picture that it's going to go back down to 0. We're going to NASDAQ 10,000. You can, pretty much guarantee in that case that we're going to get another 20-25% return in the market. And we're going to refill the punch bowl, and it's going to be even more of a divergence in the general wealth of the economy and less of a free market. Or the Fed is not going to realize just how artificially jolted this market is, and they're going to underestimate the fact that, you know, 1 or 2 rate cuts might seem good, when in reality, the market is expecting much more. And you'll see, just like the last 2 corrections, that this will start to sell off just as quick. Anyways, guys, that's enough rambling for today. Long daily update. Hope you guys are doing fantastic wherever you are. Hope you guys are having a great day. And again, leave a comment down below on any of the topics we talked about, guys. We'd love to get you guys engaging in the comments, hearing what you guys are thinking about all this. We digested through a lot of information today, but I'd love to know what you guys have on your mind at the moment. And if you guys like the video, drop it a like. Consider supporting me over on Brave or at a variety of different links down below in the description. That being said, hope you guys are having a great day for the 5th or 4th time. And I'll see you all in the next video. Stay tuned.